Hello, all my dearest students of CA Final Full English. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So, today's session is a very important session and a concluding session for you all with respect to compilation of past RTPs, MTPs, and exam papers. As we all know that we have already compiled 26 papers, which comprise of 9 RTPs, 9 past papers, and 8 MTPs, which I have done for May 2025. That is obviously applicable for September 25 also. There are no amendments in that. And that is also applicable for the Jan 26 exams. So there are no amendments in that. Okay. Now, after that particular compilation of 26 paper, that compilation of 26 paper covered RTP till May 2025, MTP till May 2025, and exam paper till November 2024. After that, there are 4 more papers which has come. Like very recently, the institute has brought RTP for September 25. The institute has brought 2 MTPs for September 2025, and the May 2025 paper suggested answer has also been released by the ICAI. So there has been an addition of 4 more papers. So I thought of making a separate video for you all in the form of this particular lecture, whereby we will try to cover up those 4 papers in today's session live. So this session will cover the latest RTP, latest MTP, and the latest suggested answer of May 2025 exam paper. So today, after the completion of this particular session, we will be having a compilation of almost 30 papers. 26 papers from the last compilation video, which is applicable for your exam, and 4 papers from here. You can compile both of them, and that will make around 30 papers. The soft copy of this particular file I have already uploaded on the Telegram channel. You can download from there. Okay. Now, one thing I would like to say before I start with the session and before I start discussing the adjustments with you all, that if any question which is repeated means if it is exactly repeated as compared to what we have done in the 26 paper compilation, I will not discuss that particular question over here, because anyways that is going to be repeated, because we have already covered that in the 26 paper compilation. Even if there is one adjustment which is different, I will discuss the entire question. But if the entire question is exactly similar to what we have done earlier, then we will not discuss that particular question over here. Okay. And you will come to know that in the MTPs, especially both the MTPs, MTP1 and MTP2, most of the questions are repeated from the 26 paper compilation. The ICAI has copy pasted the things from the old RTPs, old MTPs, and old exam papers in the current MTPs of September 2025. They have not worked anything on the MTPs. They have just copy pasted the old RTPs, MTPs in the new MTPs. You will come to know. I will give you the reference with the question number. I am not just saying for the sake of saying. I will give you the reference of the question which is already copied from which particular RTPs and MTPs. So first of all, September 2025 RTP we are going to discuss. Then we will do May 2025 exam paper, and then MTP 1 September 25 and then MTP 2 September 25. This is the order we are going to follow. Now, the very first question over here is question number 14 till question number 13. The questions are on MCQs. From question number 14, the questions are on descriptive question. I am discussing the descriptive question today. If possible, if time permits, I will also try to make a video on MCQ videos also of latest RTPs and MTP if time permits. Okay, I am not making any commitment to you all, but if time permit, I will do a video on MCQs also. Now, the very first question is, there is a company by the name called as Rainbow Limited. This company's end on 31st March 2025. Year ends on 31st March 2025. The profit is 27,22,000. This is the total income question. We need to read the last line, what exactly they want from us. They want total income from us. They don't want any tax. They want us to ignore 115 JB. No MAT calculation. They don't want any kind of concessional tax regime like 115 BAA or BAB. They don't want all those things. They just want total income as per the normal provision. Let's start. First of all, you are paying some interest of 2 lakh rupees. Now, this interest is paid for what purpose? You have taken a loan. You have taken a loan. You have taken money to buy some land. And on that land, you are going to build a building, construct a building. But that approval is not received. Therefore, the project is still under construction. Now, therefore, till the time the building is not completed, till that time, whatever interest you are paying, that shall not be allowed as a business expense. Correct? That should be what? That should be capitalized to the cost of asset. That cannot be allowed as a business expense, because till the time the asset is not put to use, you cannot claim that expense as a business expense. Therefore, this 2 lakh rupees will be added back to your business income. It will not be allowed as a PGBP expense. It will be added to the cost of asset. Okay. It will not be allowed as a revenue expense. Next one, you have paid some commission of 1 lakh rupees in the month of February. You have deducted the TDS in February and you have paid the TDS in the month of September. So, if you want the deduction of an expense, you should deduct the expense ka TDS in the same financial year and you can pay up to the due date of filing of return. So, if you want the deduction of an expense, you should deduct the TDS by 31st of March. Even if you delay the deduction by 1 day from 31st to March to 1st of April, the expense will be disallowed. So, in this case, for this 1 lakh rupees, you are deducting in February and you are paying in September. So, you are deducting in the same year and you are paying till the due date of filing of return. Therefore, this 1 lakh will be allowed as deduction. One more expense you are making as a payment of commission of 1,25,000, for which you are not deducting in March, you are deducting in May. So, you are not deducting in the same financial year, you are deducting after the year ends. Therefore, this will not be allowed as deduction. Therefore, 30% of this will be disallowed, assuming that the other person is what? Is the resident. So, for an expense to be claimed as deduction, the TDS has to be deducted by the end of the year and it has to be paid till the due date of filing of return. In the second case, you are not deducting the TDS by March, therefore it will be disallowed. 30% will be disallowed on an assumption that the other person is a resident. Third, your company's directors are going on some foreign tour for some collaboration for new line of business. For that, they are incurring some traveling expenses. So, that is a capital expenditure. Therefore, it is not allowed as a business expense. Okay. Because you are doing that particular expense for a new line of business, not for your existing business. That is a capital expenditure. It is disallowed under the income tax law. Next, there are some outstanding interest of 3 lakh rupees that is converted into a new loan. Now, remember, it is a very specifically written in 43B, conversion of outstanding interest into a new loan does not amount to actual payment. Therefore, this 3 lakh rupees which is converted into a new loan cannot be allowed as deduction. However, when this loan will be repaid, it will be allowed as deduction. So, out of this 3 lakh, 50,000 has been repaid and it is debited to the P&L. Therefore, that will be what? Entire 3 lakh is debited to P&L. So, first you will add back 3 lakh because 3 lakh is not allowed as deduction, and you will reduce 50,000 because 50,000 is actually paid by the SSE. You can claim that as a deduction. Okay. Next, there are some EPBAX and mobile phones on which you have claimed 40% depreciation. No doubt it is used exclusively for the business purpose. But EPBX and mobile phones are subject to 15% depreciation. They are not subject to 40% depreciation. It means you have claimed 25% extra. Now, 18 lakhs is how much? 18 lakhs is 40%. So, 15% is how much? Cross multiply and add back 15%. Okay. Add back 25% because only 15% of depreciation on mobile and EPBX is allowed. 25% you have to add it back. Next, you are giving some contribution to your wholly owned subsidiary for the purpose of construction of a school for the benefit of the employees. So, this is for the purpose of business and profession. It is allowed as a reduction. I am giving 5 lakh rupees to my subsidiary, and that subsidiary will use the money for the construction of school, and that school will be used for my employees' children's. Therefore, that is allowed as a business expense. There is nothing wrong in this. Next one, you are receiving a dividend of 10,000 on 10,000 shares at the rate of rupees 10 each. So, for dividend, you will reduce from PGBP, and in IFOS, honestly speaking, you should gross up that dividend. But unfortunately, ICI is not grossing up the dividend. Generally, you remember, if you receive dividend from Indian companies, then you have to gross up in IFOS by taking divided by 90%. But that is the mistake that ICI is doing over here. You should write a note in the examination that I am reducing 10,000 from IFOS, PGBP. See, while computing PGBP income, you will reduce 1 lakh. But while going to IFOS, gross it up and then write a note that because it is received, it is net of TDS. Therefore, I am grossing it up to what? To 100%. And divide that by 90%, 10% TDS is deductible on dividend income. I hope it is clear to all of you. Now, the next adjustment is a very simple grandfathering clause. Nothing great as such. I am not talking much about that. We have talked a lot about it in the earlier questions also. Next is provision for payment of gratuity is disallowed under 40A7. So, 6 lakhs will be disallowed. Actual gratuity paid will be allowed. That will be allowed as deduction. You can claim deduction of 1,50,000 rupees. Next one is 2023-24 bonus is there. You are making payment in the current year. Now, we all know that deduction of bonus is allowed on payment basis. So, the last year bonus is paid in the current year. So, it will be allowed as deduction in the current year. But out of 98,000, 34,000 you are making the payment by bearer check. So, if you pay more than 10,000 by bearer check, it is not allowed as a deduction. Therefore, out of 98,000, only 64,000 will be allowed as deduction in the current year. I hope it is clear to all of you. And last but not least, you are purchasing some commercial vehicle of 8 lakh rupees in the last month, that is in the month of March, but you are claiming full depreciation of 15%, not allowed. Only 7.5% allowed, only 50% is allowed. Therefore, balance 50% you have to add it back. So this is what this first question is all about. A very simple question. They have not asked us to compute what tax liability, so I am not computing tax liability in this particular question. Is this question clear to all of you? Please tell me. I will go ahead with the next question then. Fast. Very fast. You may reply. You may reply fast. Okay, let's move on to the next question now. Next question is a charitable trust engage in preservation of forest. Now we need to answer the following question. First question. The trust follows mercantile system of accounting in the year 24-25 and they are incurring some electricity expense of 1,20,000 rupees. But they are paying the electricity expense in the next year. So remember, for trust, whether you follow mercantile system or cash system, doesn't matter. The deductions are allowed on payment basis. Deductions are not allowed on accrual basis. Therefore, in this case, whenever that electricity expense is paid, actually paid, in that year deduction will be allowed. So when it is paid in the next year, 25-26. Therefore, this deduction will be allowed in 25-26, not in 24-25. I hope it is clear to all of you. Next one. The trust is earning some 10 lakh rupees agriculture income. The question is whether the agriculture income is exempt under section 10(1). The answer is yes. The trust is eligible for exemption under section 10(1). Generally, as per section 11, subsection 7, trust is not eligible for any exemption under section 10, but there are exceptions, in which one of the exception is section 10(1), which says that a trust which is a charitable trust registered under 2LAB is eligible for exemption under 10(1). Therefore, a trust can enjoy the exemptions of agricultural income. Okay. Next one. The trust has earned a rental income of 4 lakh rupees. Earned means it has accrued a rental income of 4 lakh rupees, out of which 3 lakh is received. And 1 lakh rupees is not received during the year, it is received later on. So do you remember that whatever money is not received, for that you can go for an option? 2 months prior to the due date of filing of return, you can say the assessing officer that I will apply the money in the year of receipt or in the year following the receipt. So the assessee has applied for the relevant option. You can check it over here. So for this 1 lakh rupees, the assessee has said that I will apply in the year in which it is received or in the year in which following the receipt. Now the assessee actually received in 2025-26. So till when the assessee has to apply this money? In the year of receipt, that is 25-26, or the year following the receipt, that is 26-27. Therefore, the assessee has time till 31st March 2027 to apply this money. I hope it is clear to all of you. Next one, question number 16, which is on TDS and TCS. There are two people over here, Mr. Raj. Mr. Raj is purchasing some scrap from Mr. Sandeep. Now remember, Mr. Raj is a buyer, Mr. Sandeep is a seller. Now if you know that if any person who sells a scrap, then that person should collect TCS under 206C subsection 1. Yes. So Mr. Sandeep should collect TCS under 206C subsection 1 because scrap is covered in 206C subsection 1. But if the buyer is resident and if the buyer is giving a declaration that I will be using this scrap for manufacturing purpose or I will be using this scrap for power generation, then the seller should not collect TCS. Remember or not, there is an exception of that under 206C subsection 1A. There is an exception. If the buyer gives a declaration, then the seller will not collect TCS. But in that case, if the buyers, that is Mr. Raj, last year turnover is more than 10 crore and the buyer is purchasing more than 50 lakhs goods, then the buyer is liable to deduct TDS at the rate of 0.1% in excess of 50 lakh rupees. So in this case, the seller is exempted from TCS, but the buyer has to deduct the TDS on 0.1% on 5 lakh rupees, that is in excess of 50 lakh rupees. I hope it is clear to all of you. Is this clear? Please comment below. Next one. Mr. Rajat has taken a loan from his employer. He is taking a loan from employer. For what purpose? For education of his daughter in Australia. And he is sending that 9,75,000 rupees outside India to a university to pay the fees. Now remember, if you take a loan from your employer, then you will not get the relaxation of 0.5%. The relaxation of 0.5% is available if you take a loan from a financial institution in India mentioned under section 80E. So if you take a loan from what? If you take a loan from your employer, then your TCS will be 5%, not 0.5%. Okay. you will have to pay TCS as per 5%. Therefore, in this case, the TCS will be 5% in excess of 7 lakh rupees. 7 lakh will be exempt, balance will be subject to 5% TCS. Therefore, out of 975, how much will be subject to TCS? 275 will be subject to TCS at the rate of 5%. Okay. Why not 0.5%? Because you are not taking the loan from a financial institution in India, you are taking a loan from an employer. Okay. Next one. Next one is a case law based question number 17, which is based on a very recent case law, that is Travel Designer India Private Limited. Okay. Now, I'll explain you exactly what is there in this particular question. The SSE has filed the return of income on 15th of September 2023. After that, the AO has found some defect in the return. So they have given an intimation to you on 10th of May and they have told you to rectify the defect within 15 days. This we are talking about section 139 subsection 9. When you file the return and if there is any defect which is found by the assessing officer, he can intimate you to rectify the defect within 15 days. That's what he is doing with you. The defects were rectified. You rectify the defect on 19th of May. After that, the department processed the return on 15th of July and then the department has issued notice for scrutiny under section 143(2) on 21st of June 2025. Now, the question is whether this notice is served on time or whether it is served late. So, the question is on time limit of notice, whether it is served on time or not. Now, what is the time limit to serve a notice under 143(2)? What is the time limit for a scrutiny notice? It has to be served within 3 months from the end of the financial year in which the return is furnished. Now, the question is which return? The original return or the rectified return? So, the court has held that the time limit to furnish, the time limit to serve the notice under 143(2) will be within 3 months from the end of the financial year in which the original return was furnished and not the rectified return was furnished. Now, the original return was furnished in 2023-24 and the rectified return is furnished in 2024-25. Therefore, the time limit will be counted from the end of the 23-24 and not from the end of the 24-25. Therefore, this notice on 21st June is a time barred notice as per this particular judgment. I hope it is clear to all of you. Now, the next one is a very simple question on penalty. There is an assessee by the name called as Mr. Kabir who is declaring an income of 35 lakh rupees and he has opted out of the default regime. It means he is following the old regime of the income tax law. Now, while processing the return, it was showing that income is 45 lakhs and later when the assessment was done by the assessing officer, the income assessed was 85 lakhs. So, now you will be imposed with penalty. Where how much penalty will be imposed? Income assessed 85 lakhs minus income processed 45 lakhs. Therefore, 40 lakhs will be considered to be underreported income. Now, on this you have to compute tax. Now, you will not directly compute tax on 40 lakhs. First, you will compute tax on 85 lakhs and then you will compute tax on 45 lakhs. Then you will take the difference and that on that amount you will apply 50% penalty because it is written in the last line that is not a case of misreporting. It is a normal underreporting. Therefore, only 50% penalty will be imposed. Okay. Now, later on 147 was also done against you and at that time the income was reassessed at 1.05 crore which is equal to 105 lakhs. So, again the penalty will be imposed. Now, the underreported income will be income reassessed 105 lakhs minus income previously assessed. How much the income was previously assessed? It was 85 lakhs. Therefore, now the underreported income is 20 lakhs. Again, you will not compute tax directly on 20 lakhs. First, you will compute tax on 105 lakhs. Then you will compute tax on 85 lakhs. Then the difference will be considered to be tax on underreported income. On that, you will apply 50% tax, 50% penalty. I hope it is clear to all of you. Now, the next question is a beautiful question. I think so. This can be an important question for your examination. There is a foreign company which is doing two things. Let me tell you what are the two things this foreign company is doing. First of all, this foreign company is selling raw diamonds in special notified zone. Where it is selling raw diamonds in special notified zone. You can check over here in special notified zone. They are selling raw diamonds. At the same time, they are earning income from display of diamonds. They are also earning income from what? Display of diamonds. So these are the two things this foreign company is doing. First of all, try to identify which are the two things this foreign company is doing. First, this foreign company is earning what? Is earning some income by selling raw diamonds in special notified zone. And second, this foreign company is earning income from display of diamonds in what? In the special notified zone. Now, the question which is asked over here is whether this foreign company is eligible for safe harbor rules. Safe harbor rules very recently notified by the CBDT, which is also included in your syllabus, as you all know. So, whether the safe harbor rule will be applicable in this case or not, that is the question. First of all, it is very clearly written in section 911. Listen carefully. That if the income is arise from display of diamond by a foreign company, if an income is arise from display of diamond, display of uncut and unpolished diamond by foreign company in special notified zone, then that is not taxable only. That income is not deemed to accrue arise in India. And if that income is not deemed to accrue arise in India, the question of safe harbor rule does not arise only. Safe harbor rule will be applicable only to those incomes which are taxable in India. Therefore, if a foreign company is earning income from display of uncut and unpolished diamond in special notified zone in India, then that income is not deemed to accrue arise in India. Therefore, the question of safe harbor rule does not arise. Yes, if a foreign company is selling raw diamond where in the special notified zone the revenue is 100 crore and the foreign company is showing profit of 3 crore rupees, then it cannot go for safe harbor rule, because the safe harbor rule says that if it wants to go for the safe harbor rule, they have to show a profit of at least 4% or more. Now, because the assessee is showing profit of only 3%, therefore the assessee is not eligible for what? Assessee is not eligible for safe harbor rule. If assessee is willing to show a profit of 4% or more, then it is definitely eligible for what? Safe harbor rules. I hope it is clear to all of you. And now one last question. This is a beautiful question. Question number 20. Mark down this question. The last two questions are very good, 19th and 20th. This is a beautiful question on DTAA. There is a person by the name called as Miss Kanika. She is earning income from country X and country Y and also from India. She is a resident in India. The details of income from India, country X and country Y. India does not have a DTAA with the following countries. And in the last line, she is paying tax under the default tax regime under 115 BAC. It means she is following new regime. New regime. No deductions of Chapter 6A and all will be allowed to the assessee. Now, how do we compute income of such assessees? First of all, we compute income in India, tax in India, average rate in India. Okay, let's do that first. First of all, from India, you are earning 4.3 crore of house property and there is a loss. You can set off this. This will be 3 crore. Then you are earning from income from singing in India, then this 5.5, then this 2 in Y, country Y, then this 2.9 in country Y, then this 7.2 in country X, this 4.8 in country X. You have to add back all of them. This will be your PGBP income. Then you are earning income from agriculture income in India, that is exempt in India. That is not subject to tax, that you will not take also in the total income. You will not take this income in total income. You will not take this income in total income. Rest all you will take in the total income and compute tax. This 1.2 crore agriculture income from country Y is taxable in India. Foreign agriculture incomes are not exempt. Then there are some deposits which you are making in PPF, not allowed in new regime. Insurance premium paid of 1 lakh rupees, not allowed in new regime. I hope it is clear. Now you will add all of them. All these incomes will be added except this agriculture income in India. Rest all will be added back. Okay. And you will compute tax. Now while computing the tax, you have to be very careful. Why, sir? Why we need to be careful while computing the tax? While computing the tax, you need to be careful because there is an agriculture income in India. And because of that, you have to follow the partial integration method to compute tax in India. How, sir? Step number 1. Tax on taxable income plus agriculture income. Step number 1. Step number 2. Tax on agriculture income plus basic exemption limit. Then step number 1 minus step number 2 will be your tax. On that, you will apply cess. That will be your final tax. And then you will divide by total income to find out the average rate in India. Okay. This will be your first part. Now I need to compute what? Now we need to compute what? The average rate in country X and country Y. Now they have not given that. They have not given us the average rate in country X and country Y. So we have to compute that. But they have given one very important data to us. That Kanika has paid 2.16 crore tax in country X and Kanika has paid 2.44 crore tax in country Y. So with the help of this tax, we can compute the average rate. How? The tax amount is given divided by the income in country X will give me the rate of country X. The tax amount of country Y is given divided by income of country Y, that will give me the rate of country Y. Now let me talk about what is the income of country X. On how much income Kanika would have paid tax of 2.16 crore. For that we need to read few things over here. Kanika has paid a tax of 2.16 crore. On how much income? For that you need to read this paragraph which I am putting as a bracket. This one. In country X, share of income is not exempt and loss from house property is not eligible for set off. So this loss is not eligible for set off in country X. Okay. So in country X, while paying the tax, you cannot set off this loss against this income, and share of income is also taxable. This 4.8 crore is taxable, this 7.2 crore is taxable, and this is not eligible to set off. Therefore, in country X, Kanika would have paid tax on 7.2 crore plus 4.8 crore. Therefore, in country X, Kanika would have paid tax on 12 crore. This will give me the average rate in country X. Similarly, in country Y, what is written? In country Y, agriculture income is chargeable to tax. So, in country Y, this agriculture income is chargeable to tax. Therefore, what is the total income of country X? Country Y, sorry, 2 plus 2.9 and this 1.2. So, this is 6.1 crore. So, this will give me the average rate in what? Country Y. So, I got the average rate in country Y? Yes. I got the average rate in country X? Yes. Did I also got the average rate in India earlier by following the partial integration? Yes. After that, you have to apply whichever is lower on your doubly taxed income, and then you will compute your what? You will compute your relief. So, this is what this question is all about. This is how you are going to do this particular question. Beautiful question it is. We have done a similar question earlier. You can go and check in your earlier RTPs, MTPs in 26 paper compilation. We have done exactly similar question to this. Exactly. There was a very minor change. Some names were changed, some amounts were changed. Apart from that, everything was similar to what I have told you in this particular question. Is everyone clear with the first RTP? Please let me know so that I can go ahead with the May 2025 paper now. Please tell me fast. Shall we go ahead with the next paper? Let's start with May 2025 exam paper now. Now, the very first question over here is a beautiful question. There are three partners, Krishna, Kinara, Komal, three partners are there, and they were doing business in the form of a partnership firm till 31st March 2020. And in 2020, after 2020, they converted that the firm into a company. Okay, all the partners become the shareholder, and in the same proportion as per their capital account, no other consideration was paid to the partners. Everything was done as per what? As per the income tax law. So you all know that if a partnership firm is converted into a company, if all the partners are becoming the shareholder and all the assets and liabilities are transferred, etc., then the capital gains is exempt under section 4713. So now today the assessee is a company. Today the assessee is not a firm. It is a company. It is converted into a company 4 years back. Now let's go ahead. The net profit of the company is 1,19,25,000 rupees. And what exactly the examiner wants from us? They want us to compute the total income. Okay. They want us to compute tax payable. And they want us to find out beneficial tax also as per 115 BAA later on. They don't want us to compute MAT. They want us to compute tax as per normal provision first and then as per 115 BAA. The turnover of last to last year is 408 crore. Therefore, the tax rate of the assessee will be 30%. Okay. Further, they are asking us to compute tax payable, not tax liability. Therefore, if there is any advance tax or TDS, we have to reduce that and then find out the tax payable at the end. So let us start with the adjustments now. The profit of the assessee is 1,19,25,000. The very first thing that the assessee is paying is 1,17,000 rupees to a transporter, road transporter. But that is unfortunately paid in cash. Generally, you cannot pay more than 10,000 rupees in cash to any person in a day. But to road transporter, you can pay up to 35,000 in cash. Therefore, in this case, up to 35,000 it is allowed. So this 26,000 will be allowed. This 37,000 will not be allowed. That will be disallowed. This 22,000 will be allowed because for them the limit is 35,000. And this 32,000 will also be allowed. TDS you have not deducted. The reason is because the other person, the transporter, has given a lower deduction certificate or no deduction certificate under 197. That is the reason we have not deducted the TDS. So that is fair enough. Okay. So if the other party, that is the payee, gives a certificate of non-deduction under section 197, then I am not supposed to deduct the TDS. So I have not done anything wrong in that. Okay. Next, depreciation as per books of accounts, you will add back. Okay. Next, one of the debtors of the partnership firm has sold some goods. Now that has become bad in my hands. So I debited that as a bad debts in my books of accounts. So will that be allowed as deduction? Absolutely yes. If the goods are sold by predecessor, but it is becoming bad in the hands of successor, it is allowed as deduction under section 3617 in the hands of the successor as per the Supreme Court judgment of T. Veerabhadra Rao K. Koteshwara Rao, if you remember that. The goods are sold by the predecessor, but the debts are becoming bad in the hands of the successor. Therefore, the successor will be eligible for what? eligible for bad debts deduction under section 36(1)(7). Therefore, it is allowed as deduction. Now, the next point is a very big mistake done by ICAI. Dividend received from listed company 5,40,000. You will reduce from here 5,40,000. Remember, students are making a mistake in the exam. They are, while computing PGBP income, they are reducing 6 lakh. That is absolutely wrong. Then you cannot blame ICAI. You cannot reduce 6 lakh rupees from here. You have to reduce 5,40,000 from here. But while showing under IFOS, you have to gross it up. That is the correct treatment. But unfortunately, ICAI has not grossed up this for the very first time. In the earlier questions, in the earlier papers, in the RTPs, MTPs and past paper earlier, they used to gross up such words. Whenever they used to see the word received, they used to gross up. But now they have not grossed up. I don't know what to do. According to me, you reduce 5,40,000 from here, gross up and show under what? Under IFOS, and then write a note. We are grossing up because the word received is written in the question. Write down the assumption in the paper. I think so. After that, they should not give you the answer wrong. Otherwise, they have given answer wrong. All those who have grossed up in May 2025. Absolutely hopeless. That is not expected from ICAI. Anyways, next one. The assessee is investing in the shares of a listed company and it is making a payment of 1,25,000 to a broker as a commission. So whether TDS is applicable on that case? First of all, this 1,25,000 rupees is not a business expense. Assessee's business is not of trading in shares. Therefore, this 1,25,000 is not a business expense. It is not allowed as a deduction. Yes, whether TDS is deductible or not deductible, that is a different question. TDS is not deductible. 194H is not applicable on commission paid on brokerage of securities. Remember or not? Commission paid on brokerage of securities, TDS is not applicable. Commission paid on brokerage of commodity, TDS is applicable in that case. I hope it is clear to all of you. Next one. The depreciation as per income tax law is 15,78,000. So that you will reduce from your PGBP income. There is nothing wrong in that. Next, the firm has purchased some machinery. That machinery was transferred to the company later on. Today, the WDV of that machinery is what? It is 12 lakh rupees. Now, the company has discarded that machinery. So, what is the effect of that? No effect. If you discard any machinery, there is no effect. The effect will come in the block of asset only if there is some money payable on that particular machinery. Is there any money payable on that machinery? Assuming that this is not the only machinery. Assuming that the company has block in which there are many machineries, this machinery is one of them which is received from firm. Right now, we don't want that machinery, so we have discarded. But there is no money payable on that. If any money is payable on that in the form of sale, salvage or insurance, I would have reduced from the block. But there is no money payable, no effect in this particular case. Okay. Now, the next adjustment is also a beautiful adjustment. The shareholding structure of the company at the start of the year is as follows. Krishna, 30%. Inara 25%, Komal 20%, others 25%. Now, during the financial year 24-25, Krisha sold 95% of her holding to her daughter-in-law. What? Sold 95% of her holding to her daughter-in-law. Now, remember, if you want to carry forward the loss, this company is a closely held company. If a closely held company has to carry forward the loss, at least 51% of the shareholders in the year of loss and in the year in which you want to carry forward the loss, it has to be same. In this case, it is not same. Therefore, this loss will not be allowed as deduction to you. It will not be allowed as deduction to you. We will not allow you to carry forward and set off this loss in the current year. Okay? Because Krisha is selling 95% of its holding. So, what is 95% of 30? 95% of 30 is around 28.5%. So, if 28.5% has been gone from Krisha and already 25% is with others, so it is going below 50%. Therefore, the outsider's holding is below 50%. It's more than 50% and the original partners are having shareholding of less than 50%. Therefore, this loss will not be allowed to what? Carry forward and set off by you. Next one. The company is having a stake in a private company. That is a closely held company of 65%. And that company is giving you a loan of 15 lakhs and the accumulated profit of the company is 31 lakhs. Now, here also you need to be very careful. If I have a voting right, if I have a equity shareholding in any company, in any closely held company of 10% or more, and if that company is giving me a loan, that is deemed dividend in my hands. Now, how much will be the deemed dividend? The loan given or the accumulated profits, whichever is lower. So, what is the lower? 15 lakh is the lower. Now, again, on this 15 lakh, the company should give me what? The company should deduct TDS. So, on this 15 lakh rupees, company will deduct TDS at the rate of 1.5 lakh rupees. Okay. Because deemed dividends are also subject to TDS under 194. Next, this will be shown under IFOS. Next, Section 47(13). The long-term capital gains on transfer of assets amounting to 55 lakhs which arose at the time of succession was exempt at the time of conversion of firm into company in the hands of the firm. But now this long-term capital gains will be subject to tax. Why? Because the condition for exemption in 2020, when the firm was converted into a company, one of the condition was that these three partners should hold at least 50% in the company for a period of 5 years. Now, within 5 years, Krisha is selling 95% of its stake, and therefore the aggregate shareholding of these three partners are falling below 50%. Therefore, whatever capital gains was exempt earlier, that will now be subject to tax. So this 55 lakhs will be subject to 20% capital gain tax now. Okay. So you have to pay 20% capital gain tax on this particular amount. After that, you have to apply what? You have to apply on normal income. You will pay normal tax of 30% because the turnover of last to last year is 408 crore. And on special income, you will pay the special rate. And then you will apply 115BAA. Now, for the purpose of 115BAA, the income will not change. The income is same only. In this question, there is no adjustment which is different. In 115BAA also, you will get all the deductions in this particular question. In this particular question, for normal provision also, you will get all the deductions. There is no difference in the income. The difference will only be in the tax rate. In 115BAA, the normal tax rate will be 22%. And the special tax rate will be as per the special rate. And in 115BAA, you have to apply 10% surcharge mandatory. In normal provision, you will apply surcharge only if the income exceeds 1 crore rupees. So this is what this question is all about. Okay. I hope it is clear to all of you. Now let's move on to the next question. The next question is also on partnership firm now. They have asked a lot of questions on partnership firm because there has been a lot of amendments with respect to partnership firm, especially the limits have been changed for 40B. Now there is an LLP in which there are three partners, J, K and L, out of which J and K are working partners. The firm is giving 14% interest to them and they are paying remuneration to working partners at the rate of 75,000 rupees. The unit has started SEZ operations in 2019. The firm is also doing some warehousing facility for storage of sugar. Now you are supposed to compute total income of the firm, income tax payable of the firm. You have to ignore the AMT provision. You have to ignore the tax as per AMT. You have to compute tax and total income as per the normal provision. So let's start now. What are the incomes that are earned by the firm? First of all, the firm is earning income of 24 lakh rupees from SEZ business. Okay, from 10AA business, the firm is earning 24 lakhs. Then the firm is earning 30 lakh rupees from warehousing of sugar. So that is the second income. These are the two incomes that the firm is earning, correct? Now, what are the disallowances? First disallowance. The firm is paying 14% interest to the partners. 14% is not allowed. Only 12% is allowed. Therefore, 2% I have to add back. Okay, I'm making the computation over here. Then the firm is paying salary to all the partners. How much? 9 lakh each. So how much the firm is paying? 75,000 to one partner, 2,25,000 to three partners. Total to all the three partners in the entire year will be 27 lakhs. So this remuneration will not be allowed. Okay, remuneration will be allowed as per 40B. So first of all, in case of a partnership firm question, you have to compute your book profit as per 40B. So I'm computing book profit. So I will add back the entire remuneration of 27 lakhs. Then I will claim 3580 deduction. You are incurring an expense of 60 lakhs, out of which 35 lakhs is land. So therefore land is not allowed. Only 25 lakhs will be allowed as deduction. I will get my book profit. Okay. Whatever book profit comes on that up to 6 lakhs, 90% of book profit. Above 6 lakhs, 60% of book profit. That I will compare with my actual remuneration. Actual remuneration I will compare with how many partners? Only two partners, because only two partners are working partners. Therefore, the remuneration paid to the two working partners is 18 lakh. So I will compare with 18 lakh, whichever is lower will be allowed as remuneration deduction. Now, after that I will get my gross total income, and from that I will claim 10AA deduction. 10AA deduction is not computed before GTI. 10AA deduction is computed after GTI. So now what is my 10AA deduction? 24 lakhs into export turnover of 90 lakhs divided by total turnover of 120 lakhs into 50%. Because the unit was set up in 2019, therefore this is the 6th year of business. So after 5 years, you get only 50% deduction. So here you will get 50% deduction. I hope it is clear to all of you. After that, I will compute the tax of the firm, which is 30%. Plus, if surcharge is applicable, I will apply the surcharge also. Now, the second part of the question is, the LLP has filed the return late. It has filed the return in December. So it is a late return. It is a belated return. The question is whether they will be eligible for 10AA and 3580. Remember, if you file a late return, then 10AA is not available. Because to claim deduction under 10AA, you have to file the return on time. By filing a belated return, you cannot claim 10AA. But for 3580, there is no such restriction. You can claim 3580 even by filing a late return also. I hope it is clear to all of you. Now, the next question is also a beautiful question, which is on NRI, Chapter 12A. That is for non-resident Indians. Mr. Joseph is a non-resident and he is a person of Indian origin. Therefore, he is an NRI. Now, let's read what exactly the question wants. We want total income of Mr. Joseph. We want tax payable of Joseph as per Chapter 12A. That is as per the provisions of NRI. That is as per the optional Chapter 12A. He is also shifting out of the default regime. It means he is following the old regime. That is 2.5 lakh, 5 lakh, 10 lakh. For normal incomes, he will follow the old regime. For special income, he will follow Chapter 12A. Okay, be very careful. Now, let's start. First of all, shares of a listed company. Is it covered in Chapter 12A? Yes, it is covered if it is purchased in foreign currency. Okay. So, is it purchased in foreign currency? Yes, it is purchased in convertible foreign currency. Therefore, it is covered in Chapter 12A. So, you are selling for 6 lakhs minus expenses on transfer 50,000. This will give you a net consideration of 5.5 lakhs. From that, you will reduce cost of acquisition 1.1 lakh. Indexation is not allowed. In Chapter 12A, indexation is never allowed. Even before 23rd July, it was not allowed. After 23rd July, it is never allowed for anybody except one case. 4.4 lakh is your long-term capital gains. So, is this first 3 points covered in Chapter 12A? Yes, it is covered. Now, to save this particular gain of 4.4 lakhs, if I invest the net consideration within 6 months in specified assets once again, then my gain will be exempt. Okay. So, am I investing? Yes, I am investing on 11th of November C within 6 months in specified assets, that is in Indian public company. Whether Indian public limited company is covered in specified asset? Yes, it is covered. So, I am not investing the entire consideration, but I am investing only 2.2 lakhs. So, proportionate capital gains will be exempt. How much? Whatever is my capital gains, 4.4 lakhs multiplied by what? If I want full exemption, I should have invested 5.5 lakhs. Entire net consideration should have been reinvested. But I am investing only 2.2 lakhs. So, multiply by 2.2 lakhs, divide by 5.5 lakhs. This will be exempt and balance will be subject to 10% tax because it is transferred before 23rd July. If it would have been transferred on after 23rd July, this 10% would have been 12.5%. Okay. But in this case, it is 10% because it is transferred before 23rd July. Amendment has come from 23rd July, not before that. Okay. Next one. Interest on government security. Purchase in foreign currency. Is this covered in Chapter 12A? Yes, it is covered in Chapter 12A. But this is net of TDS. How much tax is applicable in this case? 20% tax is applicable in this case. On interest income, on dividend income, 20% tax is applicable. 4% says this is net of TDS, so you have to gross it up. So 81,000 is net of TDS, that is net of 20.8%. Therefore, divide by 79.2% and gross it up. This is also covered in Chapter 12A. Next, interest on deposit with public limited company. Whether the deposits of public limited company covered in Chapter 12A, again covered if purchased in foreign currency. Yes, that is also covered, but expenses will not be allowed. Expenses will not be allowed. Now, this is directly gross, so I am taking 3,25,000 directly. I need not have to what? Again, gross it up. They have directly given it, so I will directly apply 3,25,000 into 20.8% tax will be applied on it. Whether interest on deposit held with private limited company covered in Chapter 12A? No. Deposits of private companies are not covered in Chapter 12A. Deposits of only public limited company are covered in Chapter 12A. Debentures of only public limited companies are covered in Chapter 12A. Debentures of private limited company, deposits of private limited company are not covered in Chapter 12A. So, on this income, you will apply what? You will apply the slab rates as per the old regime. That is the reason they have given below. The assessee is following the old regime, not the new regime. So, on this 5,55,000, you will apply the old regime, basic exemption, etc. All those things you can do. Okay. I hope it is clear to all of you. Going to the next question, shall we? First of all, I'll take a break of 1 or 2 minutes. Are you all understanding or not? Please tell me. Give me a break for 1 second. Are you all understanding? Let's go ahead now. Let me go ahead now with the next part. Question number 3. This question is on charitable and religious trust. There is a trust which is registered under 12AB. It is providing old age home. Now, there is one person by the name called as Mr. Keshav who has given 70,000 contribution to the trust. Now, if any person is giving a contribution of more than 50,000 rupees to a trust, that person is called as substantial contributor. And that person is called as a specified person under section 13 subsection 3. Now, if I try to pass on unreasonable benefit to that person, then that is wrong. Then the trust will be liable for specified income tax at the rate of 30% under 115 BBI. So Mr. Keshav is giving 70,000 donation to the contribution to the trust. Therefore, Mr. Keshav is a substantial contributor. Now, if I am giving them what? Unsecured loan of 5 lakh rupees. Why? What is the reason? Just because he has given me donation? Yes. That is the reason I am giving him unsecured loan of 5 lakh rupees. So that is passing of unreasonable benefit to what? To the specified person. So now the trust will be liable for deemed income. This 5 lakh rupees will be deemed income in the hands of trust under section 115 BBI. And the trust will be liable for a penalty under section 271 AAE of 100% of 5 lakh rupees. I hope it is clear to all of you. You cannot pass unreasonable benefit to your specified persons. Okay. Second question. A trust runs a hospital and it receives a voluntary contribution in the form of a corpus donation. So I received a corpus donation of 95 lakh rupees. Now we all know that corpus donation is exempt only if it is invested in the mode specified in 11.5. And one of the modes specified in 11.5 is the shares of public sector company. So the assessee is investing in the shares of Mrs. Healthcare Limited, a public sector company. Everything is correct. So I got corpus donation. I invested in the shares of public sector company. Shares of public sector company are covered in what? In 11.5. Everything is fine. Now later on, the government sold the stake in that company and that company ceases to be a public sector company. So will my exemption also go? So your exemption will not go for a period of 3 years from the date on which the government ceases to be what? A shareholder of that particular company. So on 31st of March 2025, the government has done disinvestment. That company is no more a public sector company. It's a private company now. So for 3 years, you don't have to worry. Within 3 years, you can sell the share and you can again reinvest in what? In a new public sector company. I hope it is clear to all of you. Next one, the trust is making some payment of 1 lakh rupees to a doctor, but the trust is not deducting the TDS on the ground that my last year turnover is less than 1 crore rupees and I am not liable to tax audit. Therefore, all these arguments are not valid for a trust. A trust has to deduct TDS. Last year turnover should be less than 1 crore or 50 lakh rupees. That argument is valid for individual and HUF, not for trust. A trust is liable to deduct the TDS. Therefore, in this case, the trust will be liable for what? Disallowance of 30%. I hope it is clear to all of you. Next one. Next question is on DTAA. It's a good question, simple question, nothing great as such. A better question was there in the RTP as compared to what it is over here. Ms. Meera, aged 28 years, is a resident individual. She provides some consultancy services in India and also abroad. Okay. She provides some consultancy services in India and abroad. From India, she has earned an income of 35 lakhs and 12 lakhs from abroad, and she has incurred some expenses of 9,60,000 in India, as you can see over here, and 2,50,000 in country K. Apart from that, she has also earned some rental income from country K, and she has also incurred some expenses. India does not have DTAA with country K. You are supposed to compute the tax liability and the unilateral relief under section 91. Now, in case of unilateral relief, the very first step, what you will do? You will always compute tax in India. Now, while computing the tax in India, let's start. First of all, you will take 35,70,000 as PGBP revenue and 9,60,000 as your expense. You will net off the income and show as a PGBP income. Then from country K, 12 lakhs minus 2,50,000, this will be your net income. And then from country K, you are earning some rental of 55,000 rupees per month. That amounts to 6,60,000. On that, you will claim 30% standard deduction as per the Indian laws. That will be your income from house property. This expense will not be allowed as deduction in India, because in India, we do not allow any expense of house property. We only allow 30% standard deduction, municipal tax and interest. That's it. No other expense. Now you will compute tax in India. You will compute tax in India. You will compute tax as per which regime? You will compute tax as per the new regime. Okay. New regime means as per 115 BAC subsection 1A up to 3 lakhs no tax, then 7 lakh 5%, then 10 lakhs, then 12 lakhs, then 15 lakhs, etc., etc., etc. Okay. This is how you are going to compute the tax. Once that is done, now you need to compute the tax in country K. Now, in country K, you are earning two incomes. One you are earning from management consultancy and another you are earning from rental income. Now, for management consultancy, the assessee has two options. First option is to pay tax on 35,70,000 directly. First option is to pay tax on 35. Assessee has two options, and the question says that the assessee should opt for the better option, whichever is lower. So let's see which is better. So in the first case, the assessee has an option of paying tax on 35,70,000, 20% without deduction of this expense of not 35,70. Let me say. First option, on this 12 lakhs, you pay directly tax at 20%. This is the first option. Second option, You can pay tax on 12 lakhs minus 250, that is 9.5 lakh, but then in that case you have to pay tax at the rate of 37%. Whichever is more beneficial, you should go for that. That is what the question says. Okay, you can check in the question. K does not have any tax deduction at source. Mira will opt for the lowest possible tax in country K. So what is lowest? Paying 20% tax on 12 lakhs is better, or paying 37% tax on 20 lakhs on 12 lakhs minus 2,50,000 is better? I think so option 1 is better. So option 1 is better. You should go for option 1. Okay. So for management consultancy, Mira will go for what? Option 1. So what is the tax in option 1? The tax in option 1 is 2,40,000. What is the income in option 1? Income in option 1 is 12 lakhs. In option 2, what is the what is the second income? The second income is 55,000 rupees rental income. For that there is no option. For that there is only one option. There are no multiple options in that case. Country K taxes rental income at 27% after giving 20% deduction. So 6,60,000 is the rental income. In country K you get 20% flat deduction, the way we get 30% in India. And on 5,27,000 you will pay 27% tax. So on rental income the tax is 140 to 560. Now pay attention. What is the tax on consultancy income? 2,40,000. What is the tax on rental income? 140 to 560. Therefore, what is the total tax? Total tax is 380 to 560. What is the total income? The consultancy income is 12 lakhs. And what is the income of rental? It is 528. Therefore, the total income is 1728. Therefore, this is the average rate in country K. Now you will compare that average rate with India, and then whichever is lower, you will apply on doubly tax income, and that will give you what? That will give you your relief under section 91. I hope it is clear to all of you. So this is what this question is all about. Beautiful question it is. Now, coming to the next question. Whether TDS and TCS will be deducted and collected in the following cases. First of all, there is a non-resident company over here whose last year turnover is more than 1 crore rupees. There is a non-resident buyer whose last year turnover is more than 1 crore rupees. So the question is whether 194Q is applicable to non-residents also. Whether 194Q is applicable to non-resident buyers also? Yes, it is applicable to non-resident buyers if the non-resident has a permanent establishment in India and if the last year turnover is more than 10 crore and you are buying goods of more than 50 lakh rupees. So all these conditions are fulfilled in India. The non-resident has a presence in India, they have a factory in India, it means they have a permanent establishment in India, the last year turnover of the non-resident is more than 10 crore and the non-resident is purchasing goods of 1 crore rupees. Therefore, the non-resident buyer is also liable to deduct TDS at the rate of 0.1% in excess of 50 lakhs because it is exceeding 50 lakh rupees. Okay, I hope it is clear to all of you. Next question. A domestic company is doing some promotion of business and for that purpose it is making some payment of commission to a resident individual. Now, if you are making any payment of commission, 194H will be applicable. Now, remember the rates have been changed from 1st of October. Till 30th September, 194H, the TDS was 5% and from 1st of October, 194H, the TDS rate is 2%. Therefore, in this case, in the first quarter which you are paying, in the second quarter, that is on 13th of July, which you are paying, okay? That is before 1st of October. So, on this commission, you will deduct TDS at the rate of 5%. From October onwards, you will deduct TDS on commission at the rate of 2% because the amendment has been applicable from 1st of October. Okay. So, this is the first part of this question. Second part. You are also giving some incentives to some people. What kind of incentives? Let's see the breakup of that. You are giving some, you are booking some air tickets for an event for Mr. Prakash and his family members. You are giving some other incentives of 60,000 rupees. You are also giving laptop to Mr. Prakash. So, what are you doing? You are doing three kind of things. First of all, you are booking some ticket for Mr. Prakash and his family members. Okay. So, that is a benefit and perquisite passed on in business on which TDS under 194R will be applicable at the rate of 10%. Apart from that, you are giving some other, out of this 1,60,000, 1 lakh is the ticket and 60,000 is other incentive. So, on that other incentive also, there will be a TDS of 10% under 194R and you are also giving a non-monetary incentive of 60,000 rupees in the form of laptop. So, that will also be subject to what? TDS at the rate of 10% under 194R. I hope it is clear to all of you. Next one, there is a website by the name called as antiquemasters.com which is engaged in providing services of e-auction. Now, we all know that in 194O there is a CBDT clarification that if the assessee is providing e-auction services, then TDS under 194O are not applicable. But that is subject to a lot of conditions. That e-auction services should only be restricted to discovery of price. They should not be engaged in buying and selling. They should not be accepting the payment from buyer. They should not be releasing the payment to seller. All those things should be done by buyer and seller directly. The e-auction website should only be engaged in price discovery. All other activities should be done by the buyer and seller independently in the market. But in this case, the e-auction services are what? They are taking money from buyer and then they are transferring to seller account. Now they are doing something which Amazon does. Therefore, the benefit of that e-auction notification will not be available to them. 194 TDS will be applicable at the rate of 0.1% on 11 lakh rupees. Why 0.1%? Because from here in this section also, from 1st of October, the rate has been reduced from 1% to 0.1%. You are doing the transaction in February 25 after the amendment falls. Therefore, the rate will be 0.1% and not 1%. I hope it is clear to all of you. Now, the next question is a question on what? It's a question on transfer pricing. It's a simple question on transfer pricing. There are three companies over here. We need to identify which of them are associate enterprise, which of them are not associate enterprise. First of all, Indiana Limited is an Indian company engaged in manufacturing and trading of electronic project. Now, it has 30% voting rights in a German company. Whether we both are associate enterprise? Answer is yes. If one enterprise holds 26% or more of voting power of another enterprise, then both of them are deemed to be associated. Therefore, we, Indiana and Star GmbH are associate enterprise. Second, Indiana appoints 6 directors in Moon Inc. Moon Inc. has total 15 directors. If I appoint 6 directors out of 15, whether we both are associate enterprise, the answer is no. If I appoint more than half of the directors of another company, then we both are associate enterprise. So in this case, we are not associate enterprise. Third, it has given a guarantee of a loan of $12 million. What is the total value of the loan? The total value of the loan is 150 million. So if I give you guarantee of a loan of at least 10% of the total loan, if you have a total loan of 150 million, I should give a guarantee of at least 15 million, not 12 million. 12 million is less than 10%. Therefore, again, we both are not associate enterprise. Therefore, only the first transaction is associate enterprise. Second and third transaction is not associate enterprise. Therefore, the answer to the first question is done. That which transactions are associate enterprise and which of them are not. Only the first one is associate enterprise. Second and third are not. Now, we need to compute the arm's length price of the international transaction. Obviously, we will compute arm's length price only of the first transaction, because only the first transaction is with associate enterprise. Rest of the two transactions are not with associate enterprise. These are unrelated parties, correct? Therefore, now what are we doing over here? Indiana is buying 1000 units from Star GmbH at the rate of 15,000 per unit and then reselling. So we need to find out the arm's length price as per the resale price method. What is first step in resale price method? The first step in resale price method is the price at which you purchase from associate enterprise and then resell to third party. Again, I am saying the first step in resale price method is the price at which you purchase from associate enterprise and then you resell to third party. That is your step number 1. So you are purchasing at 15,000 per unit, but you are reselling at a selling price of 20%. So you need to find out the resale price. At what price you are reselling to third party? So it is 20% on sales. So I will need to find out the selling price. So if this 15,000 rupees is my cost and my margin is 20%, therefore what is my selling price? So 15,000 divided by 80% is my cost. Therefore my selling price will be 18,750. 18,750 into 1,000 units will give me the resale price. I hope it is clear to all of you. Again, I am saying the first step is the price at which you acquire. I acquired at 15,000 and then at what you have resold. I resold at a margin of 20%. Therefore my selling price will be 187,500. Okay. From that, you will reduce the normal GP margin. What is normal GP margin? For normal GP margin, you will go to Moon Inc. because Moon Inc. is uncontrolled transaction now. This is third party. This is not an international transaction. So in uncontrolled margin, for uncontrolled transaction, there is a margin of 30%. So you will reduce 30% from here. Okay. Then you will see, is there any functional difference between both the transactions? Yes, there is a functional difference. What is the functional difference? Star GmbH provide us warranty of 1 year, whereas Moon Inc. provide warranty of only 9 months. It means Star GmbH provides warranty of 3 months extra. So therefore, Star GmbH deserves to ask 3 months extra cost. Correct? Therefore, whatever is the total price into 3% is the cost of warranty into 3 months divided by 12. That is the extra cost that a Star GmbH will charge to me. Therefore, I will add back to this. After that, I will get the arm's length price. I hope it is clear to all of you. Okay? You can go through the solution now. This is what ICI has done over here. Okay? Now, next question. Question number 5. In this, there are multiple parts. First, there is a resident individual who is found to be guilty of making false entry, and therefore the AO has initiated penalty under 271 AAD, and he is likely to impose a penalty of 3 crore rupees. So you might be knowing that if you have any false entry in your books of accounts, or if you omit a correct entry from the books of accounts, the AO may impose a penalty under 271 AAD on you, equivalent to the false entry. So that's what he is doing. Now to recover this penalty, the AO is trying to provisionally attach your property. Can he do so? He has taken the prior approval also of commissioner. That's what the question is. Can he provisionally attach property to recover the penalty of 3 crore rupees under section 271 AAD? The answer is yes. Generally, the AO cannot attach your property for penalty proceedings. The AO can attach property only for assessment proceeding, not for penalty proceeding. But there is only one exception, that is 271 AAD. That is the only penalty where the AO can impose provisional attachment. That too, if the amount of penalty exceeds what, 2 crore rupees. So in this case, is the penalty under 271 AAD? Yes. Is it exceeding 2 crore rupees? Yes. Therefore, the AO has the power to take the prior approval of commissioner and what? And attach your property to recover the penalty. So the answer is yes. Second question, it is valid for how much period? The provisional attachment is generally valid for a period of 6 months from the date of order. Can it be extended? Yes, it can be extended for a period of 2 years or 60 days from the completion of assessment, whichever is later. So by default, you will get a period of 6 months to attach a property. Okay, provisional attachment can be done for a period of 6 months, but it can be extended by the assessing officer by taking approval from higher authority by a period of 2 years or 6 months or 60 days from the completion of assessment, whichever is earlier. Can I tell the department to avoid this? Can I tell the department that don't do provisional attachment? Yes, you can tell the department that don't do provisional attachment, release my property, only if you do one thing, that is give a bank guarantee to the department from a scheduled bank. What is the value of property? Value of property is 3 crore rupees. Give a bank guarantee to the income tax department of 3 crore rupees from a scheduled bank. They will release the property. Then the provisional attachment provisions will not be applicable. The next question we have already done earlier. That is the case law of Lakshman Das Khandelwal. You can go and check the case law. It is exactly similar to what we have done earlier. So I am not wasting time on that. Okay. The next is a case law, recent case law, BDR Finvest Private Limited. Now what has happened in this particular question, sir? I'll let you know. What has happened in this case? The assessee has filed the return and assessee has offered some interest income of 25 lakh rupees. TDS was deducted by the deductor, but the deductor has not paid the TDS and therefore it is not reflected in what? It is not reflected in 26 AS. So if somebody has deducted my TDS, but they have not paid the TDS, therefore it will not reflect in my 26 AS. So will I get the credit of that TDS or not? So the answer is yes. The court has held that in the case of BDR Finvest Private Limited, if the deductor has not deducted the TDS, you can take action against deductor. The deductee has nothing to do in that. You have to give the credit to the deductee of the TDS deducted by the deductor, irrespective of whether the deductor has paid that or not, irrespective of whether that is reflected in 26 AS or not. It doesn't matter. I hope it is clear to all of you. The next question is a theory question. You can go through it at your end. Okay. Now, question number 6, one last question in this particular paper. Then we will move ahead with the MTPs. Pay attention, please. In this question, part 1, we are supposed to identify whether the assessee is liable to get the books of accounts audited or not as per 44 AB. Now, generally, if you are doing a business and if your turnover is more than 1 crore, you are liable for audit. But for some fortunate people, the turnover limit is up to 10 crore. Up to 10 crore, no need to do audit. Who are those fortunate people? Those fortunate people are, if your cash receipt is up to 5% of total receipt and your cash payment is up to 5% of total payment, if both the conditions are fulfilled, you are not supposed to do audit up to 10 crore rupees. Now, in this case, the aggregate receipt of the assessee is 5 crore 12 lakhs. The cash receipt is 22 lakhs. Therefore, cash receipt 22 lakhs. Total receipt 512 lakhs. Therefore, cash receipt is 4.29%. This condition is fulfilled. The payment is 550 lakhs and the cash payment is 28 lakhs. Therefore, 28 lakhs divided by 550 lakhs, it is exceeding 5%. Now, because this condition is violated, you will not enjoy the benefit of 10 crore rupees. For you, the tax audit limit is only 1 crore. The limit of 10 crore is applicable who fulfills both the condition, for receipt also and for payment also. You are not fulfilling the condition of payment. Therefore, the limit of 10 crore is not applicable for you. For you, only the limit of 1 crore is applicable. Therefore, tax audit is applicable for you. I hope it is clear to all of you. Okay. Now, the second part of the question is, Mr. Narang has issued an invoice of 3,50,000 rupees. Okay. Against this invoice, Mr. Narang has received 2,50,000 rupees by check, account pay check, and 1 lakh rupees is received on 10 different dates in cash. Now, the transaction value is 2 lakh or more. If the transaction value is 2 lakh or more, then you cannot receive 2 lakh or more in cash. Now, but Mr. Narang is not receiving 2 lakh in cash. Mr. Narang is receiving only 1 lakh rupees in cash. The balance amount he is receiving by account pay check. The question is whether this transaction will be reported in 269 ST or not. No. In 269 ST, a chartered accountant will only report if the receipt is in cash is 2 lakh or more. If the receipt in cash is 2 lakh or more, then only then you are supposed to report. In this case, the total receipt is 3,50,000. Out of 2,50,000 is by check. This will not be reported, and only 1 lakh rupees is by cash. Therefore, there is no need to report this particular transaction in 269 ST in the tax audit report. This is what they have asked in this particular question. The next question we have already done earlier. You can go and check over here. Okay? I hope it is clear. Now the last question over here. This will complete this particular paper. And in this question we have already done. Yeah, so many times we have done. This is a question on what? This is a question on domestic transfer pricing. Okay, we have done a lot of time this question in the earlier RTPs, MTPs in 26 paper compilation. Now from here onwards, maximum 90% of the questions are repeated. I will show you. I'll give you with reference number. Wait. This is an Indian company who is expected to do a transaction of 500 crore and is expected to have a tax liability of 150 crore. The question is whether they can go for advance ruling. The answer is yes. A resident can make an application for advance ruling if the transaction value is more than 100 crore. So is this company a resident? Yes, it is a resident. Is the transaction value more than 100 crore? Yes, it is more than 100 crore. Therefore, it can go for advance ruling. Second question. Can the department ask for the books of accounts? Okay. Can they call for the books of accounts? Do they have the power to produce, do the BFAR, do the board for advance ruling has the authority to ask for my books of accounts? Yes. They have all the powers as covered in section 131. That is the power to issue summon. Whatever powers are given in section 131 to issue summon, all of them are also covered under BFAR. Like the 4 powers are given under 131 for income tax authority, all the 4 powers are given to BFAR also. I'll tell you all 4 of them one by one. First of all, the power to discover and inspect anything, the power to produce books of accounts, compel production of books of accounts, the power to issue commission, and the 4th power is the power to enforce attendance of any person. All the 4 powers which are there under 131 are there with the board for advance ruling also in this particular case. Okay, I hope it is clear to all of you. Is this clear to all of you? Tell me fast. Shall I go ahead? I want some response from you all. Now MTP series 1, September 2025. Now maximum things from here. Honestly speaking, both the MTPs which are made by the ICI, MTP series 1 and series 2, September 25 are almost copied from old papers. They have not made anything new. Almost everything is copied. Everything is copied. I'll show you one by one. Let's start with the first question. Question number 1 over here. What are they asking? They are asking total income, tax liability, ignore minimum alternate tax, ignore 115BAA. The turnover of last to last year is 920 crore. So it is more than 400 crore. Therefore, this is 30%. Okay. The tax rate will be 30%. All the adjustments are repeated. All of them are repeated. You can check it. Still, I will discuss with you all once at least. This is a manufacturing associate. Since 2014, the profit and loss account shows profit of 840 lakhs. First of all, you are making some fair estimate of 18 lakhs rupees, which you make in every 3 years. We have done this adjustment earlier. It is allowed as deduction. Then you are doing some foreign travel. Directors are doing some foreign travel for a project which is abandoned. So that is not allowed as deduction. That is capital expenditure. Then depreciation as per Companies Act, that is disallowed. Then debtors who has not paid us money and therefore we have write off that debtor in the P&L. Therefore, that will be allowed as deduction under section 3617. Then long-term capital gains of 6.2 lakh rupees on which STT is paid. Therefore, it is covered in 112A. So you will reduce from here and you will show under what? You will show under capital gains 1.25 lakh exempt and balance will be subject to 12.5% tax. Why 12.5% tax? Because it is transferred on or after 23rd July. Therefore, 12.5% tax. Provision for gratuity, same adjustment. Provision is disallowed under 40A7, but payment is allowed. Whatever you have paid, that will be allowed as deduction. Industrial tariff power concession from Maharashtra government, that is considered as an income under section 224(18). None of the adjustments are like which we have not done earlier. All of them we have done earlier. You can check it. Then there is a loss of machinery due to destruction of machinery. That is a capital loss. So you will add back, and whatever scrap you have received, that you will reduce from the PGBP income. That is not an income. That will be adjusted from the block of asset. Then normal depreciation you will reduce from PGBP income. Now only this adjustment is a new adjustment, that is point number 2. Only this is a new adjustment, rest all adjustments are copy pasted. How this is a new adjustment you can check. The assessee is engaged in building and developing a rental project. From that, assessee has earned an income of 38 lakhs, which is deductible under 80 IBA. Okay, under 80 IBA, if you are engaged in building and renting a project, then you are eligible for 80 IBA deduction. So 38 lakhs is the net profit. For that, you will get deduction of 38 lakh rupees under 80 IBA. You are also earning 12 lakh rupees from outsourcing the project. Now you are not doing project yourself. You are outsourcing the contract to some other person, Dux Construction Limited. So if you don't do the construction, you outsource that to someone and then you earn the income, then it is not eligible for 80 IBA. 80 IBA is eligible only if you do the construction. Okay, if you outsource that to somebody, then it will not be eligible for deduction. Therefore, this 12 lakhs will not be eligible for deduction. On this 12 lakhs, you have to pay directly tax. And the last adjustment is of GST collected from customer. Exactly copy paste adjustment we have done earlier. You can check it. First, you have collected GST from customer, then you have refunded, and out of that, your 2 lakh rupees is still in the liability. Okay, so you have to add back to the income. That's it, as simple as that. So entire question is copy pasted. Just this one adjustment is new. Now, because just this one adjustment is new now, I have discussed all the adjustment with you. Next question. This is a question on partnership firm. What they want from us? They want total income. But as per the normal provision means they don't want as per AMT. They want as per the normal provision. Let's start. This is also a copy paste question we have done earlier. The net profit as per PNL is 95 lakhs. Okay. 13% interest not allowed, only 12% allowed, therefore 1% add back. Interest on loan taken from partner, 17% not allowed, only 12% allowed, therefore 5% add back. Then royalty of 5 lakh rupees paid to partner, it is also covered under the limit of 40B. See, there are two differences in opinion in this. Some people say that 40B you should not cover royalty. Some people say that cover royalty also in 40B. Why? Because the law says that any interest, remuneration, salary, bonus, commission by whatever name called is covered in 40B. So the royalty can also come under whatever name called. Therefore, royalty will also be coming within the limits of 40B. Some people say that royalty should not be part of 40B. But ICI is taking royalty also as a part of 40B if it is paid to partners. Okay. So this will also be disallowed as of now, but it will be allowed later on, only subject to what? The limits of 40B. Depreciation as per in accounts will be added back. Depreciation as per tax will be reduced. Next, you have purchased some building in 2021. The WDV of the building is 37.83. You are selling the building for 87 lakhs. Whatever is difference is the short-term capital gain. So you are going to give two effect. You will reduce this short-term capital gains from PGBP because it is not a PGBP income and you will show under capital gains. But within 6 months from the date of the sale, you are investing that in a bond specified in NHAI. So you will get exemption of 26 lakhs. Okay. So you will get this exemption of 26 lakhs over here. So to save this capital gains, you are investing in a bond specified in NHAI. Therefore, you can reduce 26 lakhs from here. Okay. I hope it is clear. Next one, there are 4 partners, but only 2 partners are working partners. Okay. You are paying a remuneration of 35,000 to all the partners, and fortunately, the remuneration is not debited to PNL. Thankfully, if it would have been debited, I would have been added back because I don't want remuneration deduction as of now. I will take later on. If it would have been debited to PNL, I would have added back. Now, because it is not debited, I will not do anything. Okay. Next one, the SSC has applied for a unit in SEZ, but they have been late in taking the approval by 30th of March 2022. If anybody who has taken a letter of approval on or after 31st March 2021, then you are not eligible for 10AA. Therefore, SSC is not eligible for 10AA deduction. 10AA deduction is gone because the due date of making an application for approval is gone. Okay. Next, 27,000 is your depreciation as per income tax law. You can reduce that. There is a motor car which is purchased in 2022 on which you can claim 15% depreciation. Okay. And there is a second-hand machinery which is purchased and put to use in November, on which you can claim what? On which you can claim 7.5% depreciation because it is put to use for less than 180 days. Okay. Now, the next question is on 115 BAB. Okay. Now, what? Not 115 BAB, 115 BBA, sorry, which is on non-resident and a foreign citizen earning income from India and from the sports activity or from advertisement or from contribution to any newspaper article, etc. So Gill is a foreign national and he has come to India for only 40 days. Therefore, Gill is what? Gill is non-resident. Is Gill non-resident? The answer is yes. Is Gill also a foreign citizen? The answer is yes. Therefore, 115 BBA is applicable. Now, he is earning 12 lakh rupees from matches. That will be subject to 20% tax. And he is earning 3.2 lakhs from advertisement. That is also subject to 20% tax. and is earning 17,000 rupees from contribution in articles in a newspaper, that is also subject to 20% tax. Now, he is also earning horse race income of 54,000 rupees, that is subject to 30% tax. So, question number 1, you have to compute tax liability of GIL. So, the first three incomes are subject to 20% tax plus 4% cess, and the horse race income is subject to 30% tax and 4% cess. Okay. Now, here also they should have what grossed up, because everywhere it is written received, received, received. You can see, yes, received. They should have grossed up, but they have not done gross up. I'm really sorry for that. You can write a note for the same. Okay. ICAI has not done the gross up. I'm sorry for it. They should do it. They are wrong. Next one. Are the above incomes subject to TDS? Yes. The first three incomes are subject to TDS under 194E at the rate of 20% plus cess. And the fourth income, that is horse race income, is subject to TDS under 194BB. Okay. Is he liable to file the return? Yes, he is liable to file the return. Why, sir? If he would have only earned the first three incomes, and if his TDS would have been deducted, he would have not been liable to file the return. Now, because he is also earning horse race income, therefore he is liable to TDS. Therefore, he is liable to file the income tax return. Okay. If he would have not earned the horse race income now, then he would have not been able to. He would not been able to file the income tax return. But because he is also earning the horse race income is becoming a hindrance, and therefore he is liable to file the income tax return. I hope it is clear to all of you. Now, after this, next question. Already done in the 26 paper compilation. I am giving you with reference. I am not just saying for the sake of saying. Okay. Same as question number 3 of RTP November 2024. You can go and check it. After this, next question. Same as question number 2. Part C of MTP series 2 May 2024. You can go and check. Don't repeat. Don't unnecessarily waste your time. Your time is more valuable than my time. If you don't trust me, you can go and check the 26 paper compilation. That is the reason I have given the reference. Next question is a TDS question. There are some questions which are good over here and some questions which are new over here. TDS question. There is a sole proprietor whose last year turnover is 202 lakhs. Now he is paying a rent of 15,000 rupees for building and 6,000 rupees for furniture. So the aggregate rent is crossing 2,40,000. See, in 194I, if the individual's last year turnover is more than 1 crore rupees, it is liable to deduct TDS. And if the aggregate payment in the entire year crosses 2,40,000, you are supposed to deduct TDS at the rate of 10% on land, building and furniture. So on land, building and furniture, you have to take the aggregate payment. Aggregate payment is crossing 2,40,000. Yes, it is crossing 2,40,000. You can check it. 15,000 into 12 and 6,000 into 12 is crossing 2,40,000. Therefore, deduct TDS at the rate of 10% on land, building and furniture. And if it would have been plant and machinery, then the TDS would have been only 2%. Okay. Next. An individual is there, last year turnover is 2.2 crore. Now, because an individual is there and the last year turnover is more than 1 crore, therefore 194C is applicable. Now, you are making a payment to an individual for construction of factory building. Therefore, you will deduct TDS under 194C at the rate of 1%. Why 1%? Because the contractor is individual. If the contractor would have been other than individual and HUF, I would have deducted 3%. I would have deducted, sorry, 2%. Next, you are making a payment of 28,000 rupees for professional fees and 27,000 for technical fees. Is the TDS applicable? The threshold for technical fees and the threshold for professional fees is separately 30,000 under 194J. Now, because the limit of 30,000 is separate for both of them, therefore TDS is not applicable in this particular case. Okay. Now, all these three questions were very simple. The fourth one is a good question. Okay. There is an insurance agent which is located where? Which is located in IFSC, and there is a company UVW which is an Indian resident company. Now, Indian resident company is making a payment of insurance commission to an insurance intermediary located in IFSC. Now, there is a relaxation of TDS that if the insurance intermediary is located in IFSC and that insurance intermediary is claiming deduction under 80LA, then the payer will not deduct TDS. So, it is written that it is claiming deduction under 80LA. Sir, where it is given, sir? We don't know. It is given in the form of what? In the form of amendment. Go and check the amendment video for September 2025. There is a separate notification put by the ICAI. In that is mentioned. Okay. So, that amendment video is there on the YouTube. You can check it over there. Okay. I hope it is clear to all of you. Next question we have already done. Same to same question we have already done. Don't waste time. Okay. Same as question number 5 of MTP series 2 November 2023. You can go and check the question. Next question, question number 5A, we have already done in the class also, but again I would like to say once again, because we have not done in the RTP MTP compilation, but we have done this question in the class. I'll let you know more. The assessing officer passed an order, and wrongly in the order he wrote that instead of 2022-23 he wrote 23-24. So the assessment year was wrongly written by the assessing officer. Everything was correct. Everything was correct in the order, just the assessment year was wrongly written. So because of this, Can the assessee say that the entire assessment is wrong? Can the assessee say that the entire assessment is void ab initio? The answer is no, no, no. Just because one assessment here is wrongly written, you cannot say because of some clerical and typical error, typological error, the entire assessment order is wrong. That is absolutely wrong. There is a section which says in 292B that if there is any typing error or clerical error, then that has to be ignored by the assessee. Okay, I hope it is clear to all of you. Next question, same as question number 5 of MTP series 1, November 2023. This question same as Reliance Communication Limited. We have done this case law earlier. You can go and check over there. Okay, we have done this case law earlier. Now the next question is a good question. Let me discuss this question. Last 2-3 questions are good question. These are not repeated from the earlier paper, so we will discuss this. There is a resident Indian company. What is this company doing? They have already made an application to assessing officer. They have made an application to assessing officer on a particular matter. Now they want to go to board for advance ruling also. Can they approach both of them together? The answer is no. It is very clearly written in board for advance ruling that if your matter is already pending in front of income tax authority or ITAT, then you cannot make an application to what? Then you cannot make an application to board for advance ruling. Now because your matter was already pending in front of assessing officer, therefore your application may be rejected by the board for advance ruling. This is the first part of the question. Second part of the question is, what is the remedy available for if you are agreed by the board for advance ruling? If you are agreed by the order of board for advance ruling, you can appeal to High Court within 60 days. So if you are not happy with the order of the board for advance ruling, you can appeal to High Court within 60 days. If there is a genuine reason, they will also give you an extension of another 30 days. So total 90 days time is there to make an appeal to the High Court. Okay, I hope it is clear to all of you. Next one is a question on GAR. It's a beautiful question on GAR, General Anti-Avoidance Rule. Now what is happening? There is a country X. There is India over here. And there is a company over here, Skyline company. See the diagram over here. Pay attention on the board. There is a country X, there is India. And there is a company in country X which is providing some services to Surprise Limited in India. So a company is there in country X that is providing some services to an Indian company. So the law says that that is taxable in India. Okay. The law says taxable in India because the company is providing services to an Indian company. But the DTAA between India and country X says that if a firm provides a similar service to this particular company, if a firm provides a similar service to this company, not company, but if a firm provides a similar service to this company, then that is only taxable if the firm has a fixed base and or the firm partner stays in India for more than 180 days. So for taxability of the firm, there are some conditions the firm has to fulfill. Only then it is taxable, otherwise it is not taxable. For company, there is no condition. If a company of country X is providing services to company of India, it is directly taxable. But if a firm of country X is providing services to company of India, then it is only taxable if the firm of country X has a fixed base in India or if the partners of country of that firm stays in India for more than 180 days. So therefore, to avoid this particular tax, the assessee is not providing services from company. The assessee started forming a firm and they are not making any fixed base in India. And their partners are also not coming to India for more than 180 days and they are providing services from there. So whether GAR will be applicable in this case by disregarding this firm, the answer is yes. The only objective of making this firm, there is no commercial substance in making this firm. You are making this firm only with one objective, that is with an objective of avoiding tax. And therefore, this particular case, the GAR will be applicable. The AO will apply GAR in your case. Okay. I hope it is clear to all of you. Now, one last question over here in this particular MTP. There is a person, Mr. Pradeep, whose profession is interior decoration. His receipts are 65 lakhs. In the last line, he is saying that Mr. Pradeep is saying that he is not ready to, he is not required to get his books of accounts audited as his turnover does not exceed 75 lakhs and he wants to declare income under 44 ADA. So he has two contention that he wants to declare income under 44 ADA and therefore he will not do tax audit. So can he go for 44 ADA first of all? Yes, he can go for 44 ADA because interior decorator is a notified profession under 44 ADA. But the limit in 44 ADA is 50 lakhs. But remember, amendment has been made that for some people it has been increased to 75 lakhs. If your cash receipt is up to 5% of total receipts, then up to 75 lakh benefits also will be allowed under 44 ADA and therefore we need to check whether the cash receipts are up to 5% of total receipts. These are the list of receipts. What will come in cash receipt? This bearer check will also be part of cash receipt. So this 1,12,000 will be cash receipt. Apart from that, rest all are online receipts. Now out of this 2231, this 1,22,000 is also received by bearer check. Therefore, this 122 is also cash receipt. Therefore, the total cash receipt is these two divided by total receipt is 65 lakhs. Therefore, the cash receipt amounts to 3.61%. Is it up to 5%? Yes, it is up to 5%. Therefore, the assessee is eligible for what? For the benefit of this particular section of 44 ADA up to 75 lakhs. And therefore, there is no need to do the audit. Therefore, the contentions of Mr. Pradeep are absolutely correct. I hope it is clear to all of you. Is this clear? Let's move ahead with the last MTP, that is MTP 2. MTP Series 2, September 2025. Are you ready? Now, in this MTP, almost all the questions are repeated by ICI. I'll tell you with reference number. First question, repeated. Check question number 1 of November 23 paper. Go and check. Same question, copy paste. Question number 2, repeated. Same as question number 2 of MTP Series 1, May 2024. Go and check. This question repeated. Question number 3B of MTP, May 2022. May 2025 Series 2. Repeated. Now this question is slightly not, this is also repeated only, but 1 or 2 adjustments they have done here and there. This is a question on exit tax. In case of exit tax, when a trust get merged with another entity which is doing business, then exit tax is applicable. You need to find out the accredited income. Now, how will you find the accredited income? For land, you will take stamp duty value or market value, whichever is higher. Okay. Accredited income is all assets minus all liabilities as per Rule 17 CB. So, for land, what you will take? Stamp duty value or market value, whichever is higher. For equity shares which are listed, you will take the highest and the lowest price average. So, highest and the lowest price average is 890 multiplied by 75,000. For preference shares, you will take market value, not book value. Then corpus fund is not taken in the liability. Outside liability you will take. Provision for tax is also not taken in the liability, and other liabilities, utility payment liabilities will also be taken. That's it. This will give you your accredited income. On that you will apply 34.944% tax. That will give you your tax liability as per 115 TD. Next question, same as earlier question. We have done similar question of DTAA earlier. Copy paste question. I am not wasting time on this. You should also not waste time on this. Next question is also repeated, but still I will say once again, we have repeated in the previous RTP only. TDS question, 11 lakh loan taken from employer. Just sometime before we have done, if you take a loan from employer, then the lower rate of 0.5% TCS is not applicable. So you are remitting 9,15,000 directly to German university. 0.5% is not applicable for you. 5% TCS will be applicable above 7 lakh rupees. Apart from that, you are also sending money outside India for out-of-pocket expenses. So that is also covered as what? Education expense only. Education not only covers the fees paid to the university, but also includes out-of-pocket expenses of the assessee. Okay. So therefore, this 6,98,000 will also be subject to 5% TCS. Next one is a good question. Mr. Rajat Kumar has a turnover of 18 crore in the last year. Now he is purchasing a house of 7.5 crore from Mr. Samir. So if you are purchasing an immobile property of 50 lakhs or more, you are supposed to deduct TDS at the rate of 1% under 194 IA. So on this 7.5 crore, Mr. Rajat Kapoor will deduct TDS at the rate of 1% under 194 IA. Okay. Second, he is also paying a stamp duty value of 4.5 crore and is also paying a commission of 13%. So 13% commission on 7.5 crores comes to 97.5 lakhs. So whatever commission you are paying, last year turnover is more than 1 crore. Yes, you are paying a commission of 97.5 lakhs. So Mr. Rajat will also be liable for deducting TDS at the rate of what? 2% under 194H. Why you are deducting 2%? Because commission is covered under 194H. Sir, personal commissions are also covered in 194H. Yes. If your last year turnover of business is more than 1 crore, then even personal commissions are also covered in 194H. Therefore, deduct TDS at the rate of 2% because it is commission is paid on or after 1st October. Therefore, the amendment rate will be applicable, that is 2%. Earlier, it was 5%. Next one, you are making a payment to lottery agent of 1,20,000 in the month of November. So, lottery agent TDS commission is applicable under 194G at the rate of 2%. This rate is also amended. If you are making a payment for commission on lottery, sale of lottery ticket, then TDS is applicable under 194G at the rate of what? 2% on 1,20,000 from 1st October. Before 1st October, this was also 5%. Next one, Mr. Vivek received a contract from Alpha Garment Limited. I am Alpha Garment Limited, you are Mr. Vivek. So I'm giving you a contract of making some garments, some shirts, some t-shirts, some suits. Now you are purchasing material from my associate enterprise. You can check it over here. So if you purchase material from me or my associate enterprise, then I will deduct TDS. Now I will deduct TDS on what? If you give me breakup in the invoice, then I will deduct TDS only on the service portion. But if you don't give me a breakup, and if you give me a consolidated invoice, which you are doing over here, you are giving one single invoice of 72 lakh, then I will deduct TDS on the entire 72 lakh rupees, 1%. Why 1%? Because Mr. Vivek is individual. If you would have given breakup of 72 lakh, that this much is for stitching and this much is for cloth, this much is for garment, then I would have deducted only on the service portion, not on the goods portion. I hope it is clear to all of you. Next question, beautiful question it is. I'm not saying this question, this MTP is not important. It is important. There are good questions covered in this MTP, but all of them are repeated. None of them are absolutely a fresh question. Even though a question which you are seeing as a fresh, these are also not fresh question. It is covered some or the other way. I'm not able to trace them anywhere directly, or they have made some minor changes in the question. But most of them are repeated. This question repeated, same question repeated, with same number, same dates, everything same. Check it. This question repeated. This question, so they have copied from just last MTP only. MTP 1 copied to MTP 2. Check this question. In MTP 1 also it is there. Check it. This question is there in MTP 1 also. In MTP 2 also they have covered. Next question is a good question. Okay. So let's see this next question. The AO has issued a direction under 142(2)A for inventory valuation. But that inventory valuation direction is issued to a chartered accountant. That is absolutely wrong. Inventory valuation is not issued to chartered accountant. For inventory valuation, you have to give a direction to the assessee, and then the assessee will go to the commissioner, and then the commissioner will appoint what? Cost accountant, not chartered accountant. First of all, chartered accountant is not eligible to do inventory valuation. Inventory valuation will be done by the cost accountant. Okay. Second, you cannot tell the assessee to pay this 2,50,000 rupees. No. You cannot tell the company. The amount will be determined. The fees will be determined by the commissioner, and it will be paid by the central government. So there are a lot of mistakes done by the assessing officer. First of all, chartered accountant cannot be appointed. Cost accountant will be appointed. Secondly, fees will not be borne by the assessee. It will be borne by the central government. Fees will be determined by the Commissioner of Income Tax. Check it, please. Next question, repetitive. Repetitive. Same question as question number 6 of November 23 RTP. Go and check. This is a theory question. You can go through it. Next question is on advanced ruling. Let's check this question. There is something new in this question. Okay, let's see this. Shall I? So this Indian branch of a foreign company has carried out some transactions in India with a company of 600 crores. So they have asked us to find out what is the fees of this particular transaction. So for advance ruling, you have to pay some fees. So because the transaction value is more than 300 crore, therefore the fees is 10 lakh rupees. So there are slabs for fees. If the transaction value is up to 100 crore, the fees is 2 lakhs. If the transaction value is more than 100 crore, up to 300 crore, then the fees is 5 lakhs. And if the transaction value is more than 300 crore, then the fees is 10 lakh rupees. So in this case, the transaction value is 600 crore, therefore the fees is what? Fees is 10 lakh rupees. I hope it is clear. Second, they are repeating the question once again. If you are not happy with the order of BFAR, what should you do? You should go for appeal to High Court within 60 days. In case of genuine reason, if there is a reasonable cause, you can get an extension of another 30 days. I hope it is clear to all of you. Next one last question. The last question is also repeated. We have done this question on tax audit earlier. Okay, so you can go and copy that, see that question earlier. This question is a new question. You are purchasing some Bitcoin. Bitcoins are virtual digital asset. 5,000 Bitcoins are purchased, and then you are selling 2,000 Bitcoins, and then 2,500 Bitcoins. So first you are purchasing 5,000, then you are selling 2,500 Bitcoins. So on this first 2,500 Bitcoins, there is a gain. So you will pay 30% tax on that. On Bitcoin, there is a direct tax of 30%. Transfer expenses are not allowed. In case of Bitcoin, transfer expenses are not allowed to you. Second, again, the remaining 2,500 Bitcoins are also sold for what? Sold for 28,750. Again, there is a gain. You can pay 30% tax on that. Now you are purchasing NFTs. NFTs are also virtual digital assets. You are purchasing 10,000 NFT. Then you are selling 6,000. Now, when you are selling this, there is a loss. There is a loss. Now, this loss cannot be set off against this gain. This loss is lapsed forever. Loss on virtual digital asset is lapsed. It is not allowed to set off against any income. Again, when you are selling this 4,000 NFTs, again there is a loss. You can check it. There is a loss of 4,000 rupees. This 4,000 rupees is again lapsed. Loss on virtual digital asset is not allowed. Against this, expenses incurred on sale of NFT is not allowed. Okay. While computing the virtual digital asset capital gains, the gain is subject to only one deduction, that is cost of acquisition. No other deduction will be allowed except cost of acquisition. So this is what this MTP is all about. So I have promised to all of you, to all my dearest students of South India who are struggling to understand my Hindi. Okay. So I told you that I will make a separate video for you all. I have tried my best to make most of the videos for you all in full English also. This also I did for Hindi first and then I did it for you all. Sorry for the delay. The delay was because of ICI, because ICI has released the MTP series 2 in the last week, that is around 8th to 10th of August, and that is the reason I have to wait for that particular MTP. But I have not got anything great from this MTP. MTP 2 was almost copy paste. Okay. So now we have 30 paper compilation. Follow this compilation religiously. Share this video and the 26 paper video especially to most of your friends across South India. I want it to be viral across South India. Watch this video, watch 26 paper compilation as many times as you can. Watch the MCQ video as many times as you can. These two videos, if you see properly, most of the things in direct tax will be on place. Thank you very much. God bless you all. See you soon. Bye.